Credo jumped 9.8%. Lab scores at 67, declaring a buy. This massive surge is anchored by the rollout of NVIDIA's Blackwell platform, which relies heavily on Credo's low-power, 800 gigabit interconnect cables to function. Our upcoming full teardown reveals how this critical hardware bottleneck will impact your portfolio and whether this high-flying growth is truly sustainable. Credo is lighting up trading terminals, surging 9.8% to $265.55 following its June 30th earnings beat. The company posted diluted earnings per share of $1.16, crushing Wall Street estimates of $1.05 by over 10%. This marks their fourth consecutive quarterly beat, signaling a powerful sequential revenue acceleration that has forced analysts to rapidly reprice the stock. The market is aggressively bidding up this Tier 2 interconnect supplier, betting that the explosive demand for high-speed backend networks will sustain this massive valuation expansion throughout the second half of fiscal year 2026. But does the physics of the data center justify this post-earnings run? At the heart of Credo's guidance upgrade is the rapid adoption of AECs, active electrical cables, which are copper assemblies with embedded chips that boost signal reach at low power. These cables must process 800 gigabits per second using PAM4, pulse amplitude modulation, a signaling method that doubles data transmission rates by packing 2 bits into 4 voltage levels. While competitors like Marvell and Broadcom threaten to enter the serializer market, Credo's proprietary architecture maintains a distinct power efficiency moat. The physical limits of optical transceivers at these high speeds mean copper remains the only cost-effective solution, confirming that Credo's engineering pipeline fully supports their revised guidance. Quarterly financials showing modest revenue momentum for Credo. By the fourth quarter of 2026, intensifying global tariff protectionism will compress Credo's gross margins by at least 200 basis points as manufacturing costs rise. While the market rides a wave of optimism, macro friction is mounting. The Federal Reserve holding rates at 3.63% offers a stabilizing backdrop, especially with inflation at a cool 0.6% and unemployment at 4.2%. However, prediction markets place recession risk at 7.6%, meaning capital efficiency remains paramount. Credo's recent earnings report revealed that while domestic demand is soaring, rising trade tensions and tariff uncertainty threaten their hardware partners. If new import tariffs are enacted, the capital expenditure required to transition fabrication out of high-risk regions will immediately eat into the margin expansion management promised during their latest earnings call. This brings us to the geopolitical reality of the fables, a business model where a chip company designs integrated circuits but outsources the actual manufacturing to external foundries. Semiconductor landscape. Credo is highly exposed to the escalating U.S.-China tech war. Strict U.S. export controls on advanced artificial intelligence processors directly limit Credo's addressable market because their high-speed connectivity chips are designed to pair with these restricted accelerators. Furthermore, any disruption to TSMC, Taiwan's semiconductor manufacturing company, the world's dominant foundry that fabricates the advanced silicon nodes Credo relies on, would halt the entire supply chain. Public anxiety over artificial intelligence energy consumption is also driving regulatory scrutiny. As data centers face strict regional power limits, Credo's low-power interconnects are a secular tailwind, but they cannot fully escape the trade war gravity pulling down their hardware partners. Credo reported earnings per share of $1.16, beating the Wall Street estimate of $1.05 by 10.5%, a solid beat that signals strong execution. Credo Interconnect is trending higher at 265.5. Management's headline: "We feel confident that we are going to achieve a very aggressive ramp in the second half of our fiscal year and even more next year." William J. Brennan, CEO, Q4 2026 earnings call, June 2026. 3 words: confident, aggressive, ramp, designed to make investors feel the supply chain is under control and demand is accelerating. What it's designed to make them not think about: the 325,631 shares insiders net sold in the past 90 days. That's not a vote of confidence. That's a silent exit while the stock is near all-time highs. Historically, this pattern precedes a pullback. Insiders sell the narrative, not the execution. The EPS beat, 10.5% above estimates, is real, but the trend is the story. For straight quarters of beats averaging plus 23.6% surprise, yet R&D as a percentage of revenue climbed to 20.9%, up 90.2% year over year. That's not efficiency, that's a bet the farm pipeline expansion. Wall Street is cheering. BofA just raised its price target to $340, but the divergence is glaring. Analysts keep raising targets, yet the short volume spike, 21.2% versus a 38.3% baseline, suggests the short cohort is unusually active. The engineering reality? Credo's 3 nanometers transition for 200 gig per lane products is still a yield gamble. Brennan's confidence hinges on TSMC's 3 nanometers yield curve, and if that slips, the aggressive ramp becomes a supply chain fire drill. What management is saying is, we're in control. The momentum breakdown for Credo. RSI sits at 53, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The bull case rests on 2 pillars: the imminent rollout of NVIDIA's Blackwell graphics processors, which require massive quantities of specialized cables, and Credo's low-power interconnect technology. This tech acts as ultra-fast plumbing, preventing data traffic jams. This engineering advantage justifies their forward PE, forward price-to-earnings ratio, a valuation metric comparing the stock price to forecasted future earnings, of 29.8. But here is what breaks the bull thesis. Credo trades at a trailing PE, trailing price-to-earnings ratio, which compares the stock price to actual net income generated over the past 12 months, of 105.4 times, while volume has plunged 24.1%. If Microsoft or Amazon delay data center expenditures, orders will evaporate, rendering Stifel's $350 target highly unrealistic. The critical question is this: can Credo maintain its design wins once Broadcom scales its competing serializer products? Our answer is yes, but only in the near term. Credo's architecture delivers equivalent speeds at a fraction of the electricity, the exact physical constraint hyperscalers face. However, customer concentration remains a massive risk. If their primary customer pivots to an in-house design, Credo's revenue pipeline collapses. Our AI score of 67 out of 100 reflects a conditional outlook. If Blackwell shipments ramp smoothly by late 2026, expect the stock to test resistance at $302.52. If hyperscaler CapEx slows, the stock will plunge to support at $206.89. We favor the upside scenario because physical power constraints make Credo's efficiency indispensable. Here's the macro picture shaping Credo. Strict U.S. export controls on advanced artificial intelligence chips to China directly limit Credo's customer base because their high-speed connectivity chips are designed to pair with these restricted processors. Additionally, potential new tariffs on imported electronics could raise manufacturing costs for their hardware partners, which would likely delay the global rollout of new data centers. As artificial intelligence models grow, data centers require massive pipes to move information, making Credo's energy-efficient optical and copper connection technologies act like ultra-fast, low-power plumbing that prevents data traffic jams. They face intense competition from giant chip makers like Broadcom, but Credo's ability to deliver higher speeds with much less electricity gives them a unique design advantage. Over the next 6 months, the major launch of next-generation Blackwell graphics processors by NVIDIA represents Credo's biggest growth trigger because these systems require massive quantities of Credo's specialized data cables. Conversely, the greatest threat to their stock is any delay in data center spending by Microsoft or Amazon, which would immediately slash Credo's short-term chip orders. CRDO's 45 nanometers die shrink just crushed street margin models. Wall Street's calling it a one-time cost win. We're calling it structural. Are you holding CRDO? Drop your entry price in the comments. This isn't financial advice. We're engineers, not brokers. Markets move fast, data gets stale, and past performance never guarantees future returns. Always run your own numbers before pulling the trigger. If you want our full breakdown on Astrolabs, the link is in the description. Hit subscribe for the only channel that reverse engineers stocks like chips. Stay sharp, Lab.